Rich Dad Poor Dad changed how millions of people think about money. For many of us in the real estate investing world, it wasn't just a book. It was the inspiration that got us started. It had a huge impact on me and my wife. It made us look at our lives differently. We realized we were trading time for money, just like everyone else. I actually started investing in real estate about 25 years ago. But when Lacey and I began investing together 10 years ago, I didn't have much to show for it. The reason? I was collecting liabilities and I didn't even realize it. But Rich Dad Poor Dad showed us a different path. Stay laser focused on collecting assets, not liabilities. But here's the thing, Rich Dad Poor Dad came out in the late 90s, and a lot has changed since then. We've lived through the biggest real estate crash in history, one of the longest bull runs the market has ever seen, a global pandemic, and crazy amounts of money printing. Plus, we've had the lowest interest rates in history, followed by inflation and a doubling of interest rates. We've also seen new platforms emerge, like Airbnb, which have created opportunities for real estate investors that didn't even exist back then. So I think it's time to ask a simple but important question. Do the Rich Dad principles still hold up? Or has the world changed so much that they no longer apply? Because if you're a high-income earner, a doctor, lawyer, or business owner, the answer could be the difference between building real freedom or believing you are while still trading time for money. In this video, I'll break down what still holds true, what's changed, and what most people get wrong when they try to apply Rich Dad's lessons today. And be sure to stick around until the end, because I'll share the asset column test I still use to evaluate every deal in our portfolio. Now, if you get that test right, it can help you reach freedom faster by keeping you focused on what truly builds wealth. At the heart of Rich Dad Poor Dad is one idea that completely changes how you look at money. Kiyosaki defines an asset as something that puts money in your pocket and a liability as something that takes money out. It sounds simple, but the truth is, very few investors actually live by it or use that filter when making decisions. Most people still buy things that look like assets because they appreciate in value or because everyone else calls them investments. But when you strip away the labels and look at the cash flow, you realize a lot of so-called investments are really just dressed up liabilities. So let's put it to the test by applying it to some of the most popular real estate strategies out there today: flipping houses, short-term rental arbitrage, real estate syndications, land investing, and even your primary home. We'll run each through the Rich Dad filter. Does it put money in your pocket every month, or does it take money out? That single question exposes a lot, because once you start thinking this way, the whole game shifts. You stop chasing shiny objects and start collecting real assets that buy back your time. In the next few minutes, I'll break down 5 popular strategies that sound like smart investments, but when you apply the simple test, most of them fail. Let's start with one that's become really popular in the last decade: short-term rental arbitrage. Short-term rental arbitrage is one of the newest and fastest growing real estate side hustles. This strategy, leasing a property long-term and subletting it short-term on platforms like Airbnb, didn't even exist when Rich Dad Poor Dad was first published. It only began gaining popularity in the last decade as platforms like Airbnb became the go-to for travelers. Here's how it works. You lease a property long-term, furnish it, and sublet it short-term on platforms like Airbnb or VRBO. On paper, it sounds great. No need for a down payment, and you don't have to qualify for a loan. But here's the truth. You don't own the asset. You're building income using someone else's asset. There's no equity growth, no appreciation upside, and no tax advantages like depreciation or a 1031 exchange. If your lease ends or the city changes the rules, your business can disappear in a day. That means arbitrage might generate income, but it doesn't build wealth. It doesn't build your asset column. It's an income opportunity, not an income asset. What's that called? A job. And if you're a high-income earner, a doctor, lawyer, or business owner, you already have a job, a better paying, more stable job. So if your goal is to build freedom, not just another side hustle, arbitrage won't get you there. Because under the Rich Dad definition, you're still trading time for money. It only pays you when you keep working. Now let's talk about a strategy that comes with a lot of hype and personally cost me years and tens of thousands of dollars to learn the hard way: land investing. Early in my investing career, I got caught up in the land buying frenzy in Florida that was fueled by loose lending standards. You probably saw the movie The Big Short, where the loan brokers were bragging about the number of loans they were closing each month to unqualified buyers. Back then, you could buy a property with no income, no money down, and if you structured your deal in a certain way, you could even put money in your pocket after a purchase. Because of the hype, prices were being driven up like crazy. You could buy a property for $100,000 and sell it for $300,000 a few months later. I bought a piece of raw land in Florida for $125,000. A few months later, I got an offer to buy the land for $300,000. I thought I could do better, so I decided to hold on to it a bit longer. Then the 2008 crash hit. The land's value plummeted. I couldn't sell it, not even for $5,000. So I held on to it. But holding it wasn't free. I had to pay the mortgage, property taxes, and insurance every year for years. 15 years to be exact. 15. When I finally sold it, I got $50,000. Sounds okay until you realize I still owed more than that on the loan. I actually had to bring money to closing to be able to get rid of it. What seemed like a quick win turned into a financial drain. It took money out of my pocket each month, and it never produced a single dollar of income. And that's the point. Assets put money in your pocket. Liabilities take money out. So if land isn't putting money in your pocket, it's not an asset. That experience taught me something I'll never forget. If your investment only works when the market goes your way, it's not an investment. It's a bet. You're gambling. Now don't get me wrong, there are ways to make money with land, and I'm not saying that it doesn't have a place in your portfolio. You just want to be sure that it's not a huge part of your portfolio and you can afford the monthly payments to hold the property and wait it out until the property appreciates in value. If you want to go deeper into the hidden dangers of land investing, I did a full video on it. I'll link it below. Now let's move to the next one. Another strategy that gets a lot of newbie investors excited, but has its own hidden trap once you look under the hood: leading real estate syndications. Now this one might surprise you because most people assume that leading a real estate syndication means you're making a lot of money every year. On the surface, it sounds like an incredible opportunity. You raise capital, buy big properties, and collect checks every month while investors in your syndication thank you for passive returns. But here's what most people don't realize. That's not how it works in real life. After you pay operating expenses, debt service, and distributing returns to your investors, there's often not much left. A lot of times nothing left for the general partners. And even when there is something, experienced general partners, or GPs, often set it aside as a reserve fund, not for profit, but to protect the asset and the investors. That's been our experience too. My wife and I have syndicated over 2,300 units, and across all those deals, we don't make much, if any, consistent income. Sure, there might be a nice payout years later when the property sells, but until then, it's all management, oversight, and risk. It's not passive, it's not predictable, and it's definitely not the same as owning an income-producing property yourself. Because when you're the GP, you're essentially running a business, a high responsibility one. Your investors come first, the property comes second, and you get paid last. So while syndications can create big wins over time, being a GP isn't necessarily building your personal asset column. At least not in the rich dad sense. If anything, it's a temporary asset, and it can feel more like a job with ongoing responsibilities, financial risk, and rewards that are uncertain or deferred. And when you sell, you're paying taxes, a lot of taxes. So it's not an efficient way to build wealth. It's another example of something that looks like wealth building, but really just trades time, energy, and risk for future potential, not cash in your pocket every month. So while being a syndicator might sound sexy, it's not a passive income stream. It's a second job. Now let's talk about another popular strategy that people mistake for an asset, one that's been hyped up on TV shows and social media for years: fix and flip. Now I get it. Fix and flip looks great on TV. You buy a property, renovate it, and sell for a profit. The finished product always looks awesome. And yes, flipping can generate cash, but here's what most people don't realize. That cash doesn't make you rich. Because flipping isn't investing, it's a job. You're trading time for money. The second you stop working, the income stops too. You're spending months managing contractors, getting permits, and trying to meet deadlines. And when you sell, you're right back to square one. No more asset, no recurring income, no long-term ownership, no compounding growth. And to make things worse, those profits, they're taxed at the highest rates as active income. That's not wealth building. That's working a high-stress, unpredictable job, one that depends entirely on market timing and flawless execution. And that's the trap. It feels like investing because you're buying real estate, but in reality, you're still trading time for money. You might as well be a contractor. Fix and flip is transactional, not transformational. Real wealth doesn't come from flipping homes. It comes from holding assets that pay you month after month, even when you take time off. Now, speaking of assets that don't pay you, let's talk about one that almost everyone believes is their biggest investment: your primary residence. For most people, their primary home is their biggest asset. But here's the truth. It doesn't generate income. It's not an asset. It's a liability. Now, that doesn't mean you shouldn't own one. It just means you need to understand what it really is. Your home costs money every single month. The mortgage payments, property taxes, insurance, maintenance, you pay to live there. It doesn't pay you. Yes, it might appreciate over time, but appreciation isn't cash flow. And until you sell, that value is just paper wealth. So under the rich dad definition, unless your home earns income with strategies like house hacking, short-term rentals, or maybe renting out part of your home or maybe even a separate unit, it's not an asset. And that's the trap so many high-income earners fall into. They buy the dream home, upgrade it, maintain it, improve it, but all that effort goes towards a liability. It feels like progress, but it's actually cash flow going in reverse. Because the truth is, your house might look like wealth, but until it pays you, it's just a very expensive lifestyle choice. Now that raises the real question. If so many things that look like assets aren't, what actually builds your asset column? Let's break that down next. So if your home, your flips, and even syndications don't qualify as true assets, what does? The answer is simple, but most people overcomplicate it. A true rich dad style asset is one that pays you every single month, whether you work or not. It's a cash flowing property that you own. It's one that gives you tax benefits, not a tax liability. That could be a long-term rental, a mid-term rental, a short-term rental, a medical office, mobile home park, or a self-storage facility. Anything else that you can rent and generates recurring income. The specific type of property doesn't matter as much as the principal. You own it and it pays you every month. That's what separates an investor from a speculator. In our portfolio, my wife and I own over 180 doors, a mix of long-term rentals, short-term rentals, as well as an office space. Every one of those assets does three things. It produces cash flow, it provides tax advantages through depreciation, and when we sell, we can use a 1031 exchange to move it into larger assets without paying capital gains taxes. That's how you build your asset column, with income, leverage, and control. Not through one-time wins or speculative bets, but through predictable income streams that compound quietly in the background. And if you're a high-income earner, a doctor, lawyer, or entrepreneur, that's how you buy back your time. Because eventually, those assets start paying you more than your job does. And that's when you claim your freedom. That's when you get your time back. Now let's talk about the mindset shift that ties all of this together. The part most people miss when they're trying to apply rich dad principles in today's economy. One of the biggest lessons I've learned over the years is this. It's easy to confuse income opportunities with true income-producing assets. Just because something brings in money doesn't necessarily mean it's building long-term wealth. For me, the real test has always been, does it consistently put money in your pocket? Can you hold on to it, grow it, use it to scale tax efficiently into something bigger? If the answer is no, then it's not building your asset column. If you're ready to start building your asset column the right way and avoid the same mistakes I made early in my journey, we can help. Book a free call with our team. We specialize in helping high-income earners like doctors, lawyers, business owners to build wealth with real estate. We'll walk you through how to find income-producing properties, analyze deals for cash flow, use real estate to shelter your income from taxes. Just click the link in the description. After 25 years of investing, I can tell you this, the rich dad principles still apply. In fact, they're more important than ever, but you have to apply them with clarity, discipline, and the right education. Not every opportunity builds wealth, and not every deal is an asset. If this video helped you rethink how you're investing, give it a like, share it with a colleague or friend, and please subscribe for more videos like this. Thanks for watching, and I'll see you in the next one.